Our very special guest, John Feneck from Feneck Consulting. How you doing today, John?
Hey, very good, Rich. How are you?
I'm doing fantastic. And I want to talk to you about some key things today. So since inflation and CPI is some of the key topics on people's minds today, I thought we'd go through some effects on the economy and investments. How do you think that affects the economy and investments these days?
Well, the Fed is obviously laser focused on lowering CPI to their 2% target. And a number of people in my sector, in the mining sector, have disregarded this all of last year and into this year. And we have said on Kitco March and June of last year, as early as that, that the Fed means business. And until they stop, hawkish kind of verbiage, then you have to be cautious of that. And not day trade, but you have to be trading rallies, right? A rally would have been, if you look at March of 2023, when we had the financial crisis, gold and silver responded very nicely to that. And that was like a 4, 5, 6 week rally, and then it faded, right? So, I mean, you can't just buy and hold at this point in the Fed cycle, in our opinion, because the Fed isn't done yet. And they just kind of said this on September 20th during Powell's, presser. He said, we're going to be vigilant and get this done. And to us, that means a November 1st or the December meeting, the 25 basis point hike is on the table. And to back that up, you had 12 of the 19 members say that they wanted a hike by year end. So, this all is not really wonderful news for the market. As you saw, the broad market reversed on Wednesday, the 20th, had a really bad day on the 21st. And then tried to rally yesterday, but failed and finished down actually again. So, there's really nowhere to hide in this environment because we're at such high levels in the broad market. And we've said on your show before, and we've said since May of this year on multiple shows, that we're not in the camp that the broad market makes new highs. And I know you feel the same. We've seen the S&P, NASDAQ, a lot of these major indices try and fail. And that to us is actually a good thing for gold and silver investors, because if we made all-time highs again, that would have been a really difficult setup.
So the consumer price index, the CPI, is a key measure of inflation. How is the CPI calculated and what does it represent?
So I don't have that information in front of me because I'm just walking in here. But bottom line is that CPI is the measure, and there's another measure called CPI-X food and energy that is used by investors and analysts to kind of gauge where inflation is. And in our opinion, when you go behind the scenes and look at the CPI number and really break it down, that 3.7% number that is the most current read really doesn't feel like 3.7 at all, right? I mean, if you look at airline fares year over year, they're up over 45%. If you look at gasoline at the tank, it's up significantly depending on the market you're in. So where it's hitting people is in their pocketbook, and it's not just where it really hurts is people that are retired or people that are fixed income kind of workers where they may only get a 1 or 2% raise per year, right? And that's a lot of people. So it's something that the Fed is, not throwing a party about a few meetings ago, but they were like, oh, great, we're at 3%. And now we're back to 3.7%. So we're going in the wrong direction.
Yeah, and it's very concerning that we're going in the wrong direction because the only tool that they have to bring down the rates is they have to raise rates. And that's very, very scary when you think about that because, like you said, people are struggling. Price of food is going up. Cost of gas is going up. Housing is going up. Inflation is going up. And the only tool that they've pretty much admitted that they have to bring down inflation is raising rates. So how does inflation affect investment decisions and long-term financial planning for individuals and businesses?
Well, it's different for both. I think on the individual side, we're seeing, as we speak right now, all-time credit card debt highs. So to the average person out there, they're shrugging this off, which is amazing to me. But I think as a society, we've become addicted to credit, and I say that very carefully because I really do believe that I'm in the minority. I pay for my car in cash, I pay for my house in cash. I'm really debt sensitive because I've seen what it's done to my own family. I've seen what it's done to some dear clients of mine, and people get destroyed when you're in debt because it compounds, right? If you're have a $10,000 credit card balance, even, and if you're in a situation where you're in the lower income bracket, you might be at a 29.9% APR. And how are you going to work yourself out of that as your debt level continues to grow, right? It's a very difficult situation. And I'm not just talking credit card debt. I'm talking, mortgages that are adjustable rate ratcheting up in the last 18 months, right? You're getting squeezed there if you had an arm going into this, situation. Gosh, I mean, every part of the economy is feeling this, but it's different on the client level versus the corporate level. The corporate level is probably going to start doing what I called for about 6 months ago, probably now in December, January. It was a little bit early, but they're going to have meetings at these annual meetings, Google, Apple, all these big boys, and say, look, we're cutting spending. I mean, they have to cut. And when you cut at the corporate level, that's so important to the economy, because a lot of these people that have six-figure budgets that go out there and spend like I used to, then can't do it, right? Your companies cut you off at the knees, and you basically can't do those dinners. You can't get on those planes. You can't stay in those hotels. It really has an impact on the economy. And I don't know if that's enough to kick us into a recession next year, but I'm still in the camp that we are going to be in a recession next year.
Kind of feels like we're already in a recession.
Oh, it definitely feels like it to me, but we haven't seen that admitted by the Fed yet. In fact, I mean, a couple of days ago, Powell was just talking soft landing multiple times. So, I mean, they're still drinking their own Kool-Aid.
Yeah. So central banks often use interest rates to control inflation, which I talked about. Can you give us your opinion on how this works and the potential consequences of these actions?
So we've reached a point now where I think you just alluded to, the Fed is running out of tools. And when you get to that point in the cycle, it's very tenuous, because the market, in my opinion, has already factored in, the broad market that is, a pause and cuts coming. And if you look at what Powell has actually said in the summer meetings, not past meetings, September 20th, but in past meetings, meaning June, July, he was saying, look, we're not done yet. So, we were going to have another 2 by the end of the year, he said, this summer. We already saw 1 in the summer, but we have another one coming, I think. And the market just isn't believing the Fed. And so the market continues to rise, right? And then when they actually get a dose of reality on the 20th, you've seen the sell-off, right? It wasn't like a huge sell-off, but it surely was something to take note of if you're in the bull camp. Because I really don't think we're going to see a Fed that's going to really care. And what I mean by that is, if you're at, I'm just throwing out a number right now because my computer's down, but like 4,300 on the S&P, once you break 4,200, it's going to get some attention on Wall Street. Once you break the big round number of 4,000, then it's really going to get some attention on Wall Street. And I'm in the belief that the Fed is not going to intervene there, meaning the Fed put is gone right now, right? They're not going to have your back as an investor at 4,200 or 4,000. They might at 3,500 to 3,750, somewhere in there, right? Meaning that they would cut rates potentially at that level, but that's still a long, long way from here. So I think, again, just going back to this fact as an equity guy that we haven't made new highs is really meaningful when you look at the fact that the broad market rally started March of 2009, which is 14 and a half years ago.
Yeah, it's been an epic run and had to end at some point, and it feels like we're in a bubble and the bubble's about to burst. That's just the way it feels. I know the housing here in Canada is just completely a major problem. The average home here in the GVA, the Greater Vancouver area, is $2.4 million. How is an average person going to be able to afford a home? How are kids and teenagers and young adults going to be able to buy a home when the average home is $2.4 million? That to me is a major problem. And when I talk to real estate agents that obviously make their livelihood by selling real estate, in their opinion, because they need to keep selling, they think it's going to double from here. And I'm like, well, if it does, and the average home is $5 million, how does that make any sense? Like, you're going to have a huge discrepancy between the haves and the have-nots, and it's just going to keep getting bigger and bigger and bigger. So it's a major problem across North America. I know it is here in Canada. And I blame our leadership. I think our leadership is doing a poor job of managing these issues. And when you say to the people and the public, hey, the only thing we can do is keep raising rates, that's not a good solution for me. I don't like that solution because you're just putting people, like you said, deeper and deeper into debt. And eventually they're going to get to the point where they're going to be able to default on their mortgages, default on their credit cards, default on their loans, student loans, car loans, lines of credit, personal lines of credit, business lines of credit. And then that's when you have a recession. So it's a very scary time right now, in my opinion. And I think that, in my opinion, in Canada, the United States, I blame the leadership. I'm not a fan of Biden or Trudeau. I think they've done a very poor job. And somehow today, Zelensky went and sat down with Biden, and he's asking for another $24 billion. So somehow Biden's like, yeah, sure. I mean, we're in debt and we have rising rates consistently, but Zelensky wants 24 billion. Let's give him 24 billion. That doesn't add up for me. Like, something isn't adding up, right? So what advice would you give to individuals and businesses looking to protect their finances and investments in this inflationary environment?
Well, for businesses, it's different than for consumers. The consumers have, it's like turning a cruise ship for some of these businesses because they are so large. It's going to be really difficult to do that quickly. But there are some things they could do, but probably won't do right away. And that means, if I were in charge of a company, I would have already cut budgets last December, because I really would have seen that. I've lived 08, 09, right? I was out there looking at steakhouses a third or half full, Starbucks lines, 3 or 4 people like long instead of 15 long. People will go to needs rather than wants in a recession, and we're skating towards that right now. By next year, I think we're going to see that a lot. My suggestion on the personal level is simply, work with a financial advisor about budgeting. Just getting a 90-day budget together and actually counting, like maybe pay for cash for things for 30 days and write down everything you're doing. You'd be really surprised at how much you spend that doesn't need to be spent, right? I've done this with my own family where I've said, look, just for 30 days, just track everything that you do. And it's amazing the results, because you find that you're spending money on a lot of things you really don't need to spend money. And if everyone were to do that and really care, as opposed to just charging things, I think they'd be in a better position, because we are going to a very difficult place, I think, within the next 24 months. I think it's just going to be a much more challenging environment.
Yeah, I agree with you. It's kind of scary right now where we are. And I feel like we have a housing bubble very similar to 2008, 2009. And I feel like it has to burst. I think
it's going to be worse.
Yeah. How can people continue to afford these prices? It doesn't make any sense. So there are markets where housing is affordable, but in the major markets like the Californias, the New Yorks, the Miamis, the Floridas, the Torontos, the Vancouvers, it's completely outrageous. And even if you're driving an hour or 2 hours away from Vancouver now, yesterday I took my son to soccer, and we were like 2 hours away from Vancouver, and I'm thinking, oh, okay, these are some nice homes. They're probably cheaper. No, average home is still 1.2 million. And I'm like, this is crazy. You're driving 2 hours away from the major city, and you're still paying $1.2 million for an average home. So something has to give, in my opinion. And I feel like the housing is where it's outrageous, and something has to give, in my opinion. So looking ahead, what trends or factors do you believe will influence the future of inflation and use of the CPI as an economic indicator?
So what factors do I think will change the direction of inflation?
Yes. What can we do? What could possibly be done, other than, if there's anything other than rate hikes?
The Fed is running out of tools, as I said. And so I think something, Powell says very like clockwork at every press conference. If you look at the first 5 minutes or so, he says, how this is affecting the low to middle income families. It's like he's just checking the box. I apologize, but that's really what he's saying. I don't think he has any clue as to what low middle income families actually do go through. I grew up poor. I I basically can see, as you said, Rich, already in the States, the have and have nots gap getting way bigger, and we're not at like super rich and poor yet, but the middle class is shrinking. And the Fed doesn't understand that, how much damage they're doing already. Like, to continue to raise rates at this point is pretty ridiculous. But again, we are just trying to report things to our clients and followers as we see them, right? I'm not trying to, like, if I were talking my own book last year, I would have told you about rate cuts, because I know two prominent competitors of mine were talking about rate cuts as early as September of 2022. We didn't get a pause situation, really hardcore pause yet. So where is this rate cut coming from? You can listen to what the Fed members that vote have said. Go look at the Fed minutes from June, July. We haven't seen the one for September 20th yet, right? But they're all saying that there's no rate cuts on the horizon. Not a single member is talking a rate cut right now. So is that bullish for the market or for gold or silver? Not necessarily. But I think what's going to happen, Rich, is the broad market's going to not make new highs. A sector rotation will take place into names like a Newmont, right? That's trading at $40 US with a 5% dividend or so. Like, that's very attractive to value managers. Now, again, we're in this growth phase and have been for so many years. It went off the rails this year, as you and I have talked about on previous shows with tech and AI. I think that's starting to like slowly fade. And that's really positive, because we need a sector rotation to happen. If you look at biotech, it's starting to fade. If you look at real estate stocks, they're starting to fade. This is all really, really good, because a lot of the momentum is in these parts of the market.
Now, you were recently at the Beaver Creek Conference in Colorado. Can you tell us a little bit about that conference and what some of the commodities experts were saying about the economy and its effects on the sector?
Well, I did attend both that and Denver Gold to follow it up. For those people that don't know, you should really think about attending that junior conference, especially because it's usually held at the same time every year. Beautiful Park Hyatt and Beaver Creek right outside of Vail. And a lot of topics are covered. And really one of the overarching themes was the negativity, I thought, of the CEO, much like I saw in January of 2016, where CEOs are pretty beaten up right now. And I can't say anything other than they're right. I mean, they're getting shorted. They're getting downticked by these banks. I mean, it's unbelievable, Rich. I mean, like I've actually started a campaign that isn't like public yet, but I'm doing research on how many stocks that I follow, which is over 150, that are getting downticked on 500 or 1,000 shares on a daily basis. And I'm sending images of this to the CEOs or CFOs of the companies, and we're planning to do something about it. I can't really disclose more than that, but all I can say is that if I'm out on the bid, at 10 cents on a stock, and I see a print of 500 shares at 8.5, it pisses me off, because,
Of course.
hey, they're saying, I want to buy your stock at 10, and somehow my broker dealer is telling me it's dark pools, it's the market maker's fault, and no one's taking accountability. And it's really ruining some of these companies' charts, and it's really unfair. Like, let the market just be fair. That's all I'm asking for, And anyway, we're that may be a topic for future Beaver Creek kind of conferences. I really feel that I was fortunate enough to speak on energy transition there. I think there's a lot of interest at the high net worth level of diversifying their portfolios away from traditional investments like the S&P or real estate and into something more tangible like gold and silver.
So I want to touch on that. So where do you think gold goes from here?
Yeah. So we have been extremely measured. If you look at our work from 2016 to now, we have basically just said, we don't go like more than 6 months out really in predictions, because I find that the market that we all live in and have to deal with now is so unpredictable. It's very difficult to look out much further than that. But I can just say that some point next year, we're going to make an all-time high on gold. And for me to say that is really going out on a limb, because I've always been very measured, especially with silver, coming from a silver background. I've been in the camp all of last year and all of this year, and I've said on your show that we will not break 30, and I still feel that, because $30 an ounce is major resistance if you look at a chart going back 5 or 10 years, right? And so Would I benefit from saying that? Yeah, silver is a top 3 holding for me, but I'm not, saying it yet because it's not true, right? The gold to silver ratio as we record this is around 82-1. So gold is continuing to lead silver. When you see silver start to outperform a little bit, that's going to be a really bullish sign for the entire, precious metals complex. To answer your question, I think gold will hit an all-time high next year, and it'll really start M&A activity. I know a lot of majors are meeting with some of the companies that attended at Beaver Creek. I've never heard probably more potential M&A activity than I heard at that conference, which is really bullish. Large cap companies are now coming to the realization that their production profiles are declining and they have to start doing some things. So a lot of the companies I invest in have 2, 3, 4 million ounces of gold, and they're just hanging out, right? Like they're not going crazy with drilling this year, Rich, because are you being rewarded? The answer is no in most cases. So why drill all these holes at a very expensive cost when the market's kind of just shrugging it off? So I think that's a prudent approach for smaller companies right now, is try to hunker down a bit and conserve cash. And, next year when things get rocking and rolling, that's when you go back to the drill bit.
Yeah, I heard a stat that gold is only 7% away from all-time highs. So in my opinion, gold is the inflationary hedge. So when we're in an inflationary environment, that's typically where people start investing in gold. So it's been weird. There's been a lot of divergence in this market because gold has been kind of stuck at 1900 and hasn't really made a big move in this inflationary environment, which is very, very odd. So there's a lot of odd things happening. So I don't know why. Do you have an opinion on that? Like, why in this inflationary environment is gold not doing better when it's probably one of the best hedges against inflation historically? Institutions, investors typically pour into gold in high inflationary environments. We're in a high inflationary environment and gold just stuck at 1900. Why do you think that is? You have an opinion on that?
Well, 2 things. I think it's important to note that $1,900 gold is a pretty high price, right? And when you look at history, and there was a period of time this year where we were above 1,900 an ounce in consecutive days over like 130 to 150 days, which is crazy. I mean, so that's a positive takeaway that since the financial crisis of March, more and more money is putting a floor on gold. That's huge if you're a gold bug. Number 2, the U.S. dollar has just been super strong. I mean, I've been actually told on some podcasts, we can't talk about that. I'm like, why? Because it's true. I mean, it's like the U.S. dollar has been raging higher. Take a look at a chart of UUP, which is the biggest tracker of the U.S. dollar. It's a beautiful looking chart. Hopefully it's going to back off a bit here. That would definitely help gold and silver. And, that's just, some headwinds, Rich. I mean, it's where I think part of it also is that look at what we talked about on previous shows. We talked about tech doing really well this summer and in spring. We talked about AI, stocks like NVIDIA and stuff doing really well. I mean, these are problematic because people that are still growth momentum type buyers are saying to people like me, see, I told you so, right? Like this market's just on steroids still and you're stupid, right? Well, we don't think so.
Yeah, no, I don't think so either. So really the last thing I want to get your opinion on is oil. I've talked to you before about an ETFC OMT, which pays a 30% dividend. And I've done really well on it because not only do I get a 30% dividend one time annually, but oil has been on a tear. I think oil's low this year is about 65 and its high is probably around 93. And we're sitting right around $90 a barrel. JP
Right.
Morgan came out this week and said that they feel like oil is going to go to $150 a barrel. Now, I'd be really happy if that happened because of my investment, but I wouldn't be happy about it at the pumps because that means we'd be paying way more for our gas prices. What do you think happens from here with oil? Because I believe we're going to see at least $100 oil here pretty soon. What's your opinion?
We've said on multiple shows this summer that, we think the environment for oil looks good for the next 1 to 2 years. And again, I don't really go out there and start talking 3 to 5 to 10 years out. It's just too hard to look. But now at $90, yeah, I mean, I don't know about the 150 number. I remember Goldman Sachs had an analyst there had the same thing during Katrina many years ago at 150 and never came close to that. So we'll see. But, I think it's problematic for investors, like you said, at the pump, but also if you're trying to get around, like on an airline, like a cruise ship, like these companies are just going to ratchet up prices. They're going to use this as a huge excuse, right? Because when prices came down, they didn't lower prices. When prices go up, that a lot of their bottom line is fuel, right? So look at what happened also in the news yesterday. I don't know if you noticed on CNBC, but there's an article out there that Russia is now messing with exports, and that's never good. And so I think that the situation for all commodities looks really, really good right now. And I can't say we're at a commodity super cycle type setup yet, but I will say that, there's areas of the market like oil, like uranium that are doing quite well.
I agree with you 100%. Thank you for joining us today, John from John Feneck Consulting. John, you want to talk a little bit about what you do at John Feneck Consulting before we say goodbye?
Yeah, sure. So I will just, throw this out to anyone who happens to be on the East Coast in the U.S. The people at Precious Metal Summit that run Beaver Creek, and I had lunch about 6 months ago, and I was talking to them about the demand I get from my companies, CEOs that just have a relationship with me in the copper space, uranium space, lithium space. And they always say, I'd love to go to Beaver Creek, but, and the but is, it's mostly a gold and silver conference, right? So Misha and Jessica Leventhal have basically started officially now a new conference April 29 and 30 of next year that I'll be an advisor to. And that is going to focus on battery metals and critical mineral companies only. So really excited about that because there's so many good juniors out there that, don't get enough exposure, I think, at least in the US. I know in Toronto and some other markets, they have these kind of conferences, but we really don't have a major conference like that in the States. Number two is just, again, we have a newsletter, which is very affordable, but we also have real-time macro updates. So to give you an example, when the Fed came out September 20, I'm actually writing notes real time, and then I'm sending that email off in a couple of parcels to my followers and paying clients and saying, like, this is what Powell's saying, and here's how it's going to affect, commodities. So I think that real-time aspect of what we're doing, Rich, while it costs a little more than the newsletter, is really helpful to clients. We get great feedback because there's only really one or two other competitors in the US that are doing this. So, I would just say to your followers, listen, contact me. I think this is the time you want to, align yourself with someone like myself to try to get an idea of how to, play this market. And we'll try to work with you within your budget.
Really appreciate your time today, John. Always a pleasure. John Feneck from John Feneck Consulting. If you're not winning, you're probably not watching. We bring you the winners, CEO interviews, trending topics, engaging shows with engaging guests, and we'd love to bring it to you first. Hope you enjoyed the show. If you like the video, please smash the like button, comment down below, share the video everywhere, and subscribe. I'm your host, Richard D'Souza from the Rich TV Live podcast, saying, have a nice day. We'll see you soon. John, until next time.
Thanks, Rich.
Have a nice day. Cheers.